All right, so for today's video, I really want you guys to set aside 10, 15, 20, 30 minutes, however long this video ends up being, because in today's video, I'm literally going to break down my entire strategy from start to finish, everything you need to know about day trading, confirmation, stop losses, all that good stuff. So like I said, set aside the next 10 to 30 minutes. If you don't have that time, save this video, come back and watch it when you do have that time, because this is a video that you're not going to want to skip. And I can guarantee you it's going to be more helpful than 99.9% of the videos out there. But if you do find value in this video, as always, make sure to subscribe to the channel. But let's hop into it. All right, so when it comes to a trading strategy, I see a lot of traders hopping back and forth and not really knowing what strategy to stick with when it comes to trading. So in today's video, I want to share the strategy that works the best for me. And like I said before, we'll go over confirmations and all of that good stuff, as well as intraday setups that I like to look for. But as far as the main strategy that I like to use when I am trading, it is known as supply and demand. Now, why supply and demand is so important when it comes to trading is because these are institutional footprints left in the market to let us know where price is likely going to trade back to. And typically when we trade to those levels, that's where we're going to see a reaction in the market. So when it comes to trading supply and demand, we can first start off with demand. What I am first looking for in the market is going to be a large green candle. Now on my screen, my green candles are going to be these blue candles right here when I start showing you guys some examples, but I am looking for one large candle to the upside. Now, when I say large, it really depends on the overall price action. It's pretty subjective, but you want to look for a larger green candle when compared to previous price action. So that is the first thing that you want to look for. Obviously, there is going to be wicks on those candles. So here's our little lower wick, and then here is our upper wick right here. But once you identify that large green candle, you then want to look one candle to the left. Now, this first candle to the left has to be a small red candle. Now, when I say small red, the definition of small is pretty subjective. You know what I'm saying? Anyways, so the red candle, it's pretty subjective to how big the green candle is. Like if this green candle was all the way down here, then that wouldn't be a small red candle. If this green candle was all the way up here, then yes, it would be a small red candle. If it was all the way up here and then the red candle was all the way up to here, then yes, that is still a small red candle. So again, it's subjective to how big this green candle is. But like I said, you want a big green candle and then a small red candle to the left. And again, this red candle can have wicks. But now from here, what we are doing is we are going to mark the lower portion of this red candle. So the lower wick to the high of this red candle. Also, it depends on how low this green candle's wick is. If the green candle wick is lower, then you're going to mark this zone starting here. So this is going to be classified as a demand zone. So what we are seeing happening here within the market is institutions were trying to get long. However, all of their orders did not get filled because of this very large and aggressive move. If you are an institution, you are not able to market order. The reason being, if we just pulled up order flow right here, say you're a large institution like JP Morgan and you want to get filled on 100,000 S&P orders, well, there's not even enough passive sellers to fill all their orders. So what's going to happen is when they market order, you're getting filled at the best possible price. So price is going to make a very large and aggressive move up because there is not enough liquidity to fill those market orders. So what these institutions do is they use limit orders. They wait for price to trade back to where their limit is, and if it does, they will get filled. So because price makes a very large and aggressive move up, they're going to leave their institutional buy orders down in this demand area and wait for price to trade back down into it. Look for them to get filled to take price higher. So what we do, again, depending on which candle's wick is lower, if the green candle's wick is lower, you'll start there. If the red candle's wick is lower, you'll start there. But you're going to mark it from the bottom wick, whichever one is lower, to the upper wick of that red candle. Now, this is going to be your demand zone. Now, typically within demand, what we are going to see is a majority of the time, we are going to see a reaction either off of the upper wick, so this one right here, or the open of that red candle, which is this right here. Like I said, we will see a reaction at these 2 points a majority of the time. There are times where price will go lower before reacting, but in my experience through using supply and demand, a majority of the time we will see a reaction here when we trade down into a demand area. So let's go ahead and let's make this green so we know it's demand. And again, what we are looking for is for price to trade down into this area, whether it be that upper wick right here or the open of the red candle here. Again, typically we'll see the reaction right there. But once we get the reaction, that's when we want to look to go long. And I'll talk about reaction and confirmation here in a little bit. But for now, this is how you're going to draw your demand zones. On the flip side, though, we have our supply zones. Now, when we are looking for supply, the first thing that we are going to look for is going to be a large red candle. Once you identify that large red candle, you then want to look one candle to the left, and it has to be a small green candle. Again, the green candle, by definition of small, is subjective to how big the red candle is. Now, what's happening here is there were institutional sell orders that were not able to get filled on this move down. Again, they're not able to market sell because it's going to push price way too quick in the opposite direction. They're going to leave their limit orders in the area that they were looking to get short, and they're going to wait for price to hopefully trade back up into it. That way they can get their orders filled and take price even lower. So what we will do, depending on which upper wick is higher, you will take the lower wick of that green candle to the upper wick of that green candle, and that will become your supply zone. Or if the red candle's upper wick is higher, then you'll just mark it to that. So now what we are looking for is for price to trade back up into this area. Again, ideally to the lower wick or the open of that green candle is typically where we are going to see the reaction within the supply zone. So we are looking for price to trade up into it, look for the reaction to get short, and to take price lower. So now I want to talk about timeframes and show you guys some examples of me plotting supply and demand. So typically I will start on a monthly or a weekly time frame. It's just I already know for a fact that we don't have any on the monthly or the weekly. We don't even have any on the daily. So let's go ahead and break it down to the 4 hour. So as we can see on the 4 hour right here, really nothing that we could draw as far as a demand zone or a supply zone. So then from there, after the 4 hour, I'll break it down to a 3 hour. All right, so there was actually a few demand zones over here on the 3 hour. So right here, you can see that we have a larger green candle to the upside. What do we want to do? Look one candle to the left. That's a small red candle. So as a result, we are going to mark the lower wick to the upper wick of that red candle and project it to the right. Same thing over here, larger green candle, smaller red candle, mark it from lower wick to upper wick and project it to the right. Same thing here, large green candle going up, smaller red candle, mark this from the upper wick to the lower wick and project it to the right. And then one final example right here on the 3 hour, large green candle, small red candle right there, or smaller compared to the large green candle, mark it from lower wick to the upper wick, project it to the right. Now let's go ahead and break it down to a 2 hour. And actually, before we do that, we have a 3 hour supply zone right here. Large red candle down, small green candle to the left. So as a result, upper wick to the lower wick, projected to the right. That is going to be your supply zone. And you can see that we rejected off of this area before coming all the way back down here and then eventually breaking above. So now let's go ahead and break it down to a 2 hour time frame. So we have a new 2 hour demand today. Very large green candle on the 2 hour, small red candle to the left. As a result, we are going to mark lower wick to upper wick and project it to the right. And that is a fresh demand zone based off the 2 hour. There's another 2 hour demand over here that's already been tested or pretty much tested. Again, large move up, smaller red candle. So as a result, we are going to mark this from this lower wick to this upper wick, and again, project it to the right. Looking at a 2 hour supply zone over here, larger red candle down, smaller green candle to the left, mark lower wick to upper wick, project it to the right, and that is going to be a supply zone. There was another one right here, small green candle, very large move down, and even another one right here. Actually, there's a few, but again, there's a supply zone. Here's a supply zone. And again, it all depends on reaction when we traded those areas. There's a 2 hour demand right here after that big move up, bottom wick to upper wick, and that is your demand. Now, one thing I do want you guys to make note about while we're sitting here and drawing all these zones, as you can see, some of these zones end up being pretty large. Like here on the S&P futures, this 2 hour demand is from 59.08 all the way down to 58.52. That's like 50 something points. We don't want to watch the whole 50 points for this potential demand. Again, ideally, we are going to see a reaction at the open of the body or the upper wick if we're talking about demand. If we're talking about supply, we are either going to see a reaction at the lower wick or the open of that green candle. So instead of watching 30, 40, 50, 60 plus points of an area that could potentially bounce or reject, for supply, just watch the lower wick and the open of that green candle. For demand, just watch the open of the red candle and the upper wick. And I live trade this every single day. If you guys join my live streams, you know this strategy works. So what I am showing you guys in this video, it actually works. I trade it live in front of hundreds, if not thousands of people on a daily basis. So after the 2 hour, I'll then break it down to a 1 hour and look for any other zones. As you see over here, we actually have a really nice 1 hour supply right here. Large move down, one candle to the left is going to be a small green candle, and here is our supply. After the 1 hour, I'll then break it down to a 30-minute time frame. Again, looking for any potential supply or demand zones. So here is a supply zone right here that we rejected a little bit in the overnight session. So here is our supply. Could have made for a good scalp. And then there was another one right here that we ended up breaking above. And after the 30-minute, I'll then go back to a 45-minute. And as you can see over here, this previous supply, I believe we plotted that on the 1 hour, is also a 45-minute supply zone. We had one right here, a 45-minute supply that we tested before going lower. So through the examples that I've showed you guys, you've already seen some supply and demand zones that end up working out. But you've also seen supply and demand zones that did not end up working out. So that leads me to the next point, is going to be confirmation, because we never want to enter long or short just because we hit a level. We always want to look for confirmation. Now, one thing I do want to point out before we hop into the confirmation is when supply is broken, it will not become demand. It will not become support. Again, these are unfilled orders within the market. If we fill the entire zone, then all the orders have been filled. It does not magically turn around and become a support area or a resistance area. If supply is broken, you delete it off your screen. You will never use that level again. If demand is broken, delete it off your screen. You will never use that level again. All orders are filled, therefore we don't care about it anymore. So now when we trade to these areas, for example, if we trade down to a demand area, we want to use volume price analysis to confirm that the level is truly valid. So let's just say magically that there was a 30-minute demand zone right here and price traded down into it, and it ended up bouncing off of it on this red candle right here. Well, this is what we would be looking for as far as a reaction to say, hey, this demand zone is actually valid. Again, you don't want to enter just because we hit it. We want price action and volume to say, hey, this level is valid and you should be taking this trade. So we trade down into it. We get a long lower wick. We're watching the volume as well to confirm that there's actually buyers present at the area. We're going to look for things like bullish hammers, dragonfly dojis, bullish engulfings, lower wicks, or just overall absorption at that key level. If you see any of those, as well as the elevation in the volume, which is going to be the most important, but the elevation in the volume is going to show you that orders are actually getting filled. So if you get confirmation in the price action, as well as the volume, wait for the candle to close. Typically, I will snipe entries based off a 5-minute time frame or a 2-minute time frame, but once that candle closes, that is then when I will take the trade. The reason we want to wait for a candle close is because if we're basing a trade off a 5-minute time frame and it's only 3 minutes into that candle, well, there's still 2 whole ass minutes that price could reverse and completely destroy that confirmation candle. So when the candle actually closes and you get the confirmation, that is when you get into the trade. So if you were to take this 30-minute demand zone at the close of this 5-minute candle right here, how do you identify what your potential risk is? Well, for me, the way that I define my risk as well as my stop loss is the candle that confirms my trade. My stop loss is on the opposite side of the confirmation candle. So whatever candle says, hey, now is the time to get into the trade, my stop loss is always on the opposite side of that candle. So for this example, if we entered long at 63.44 because price came down, it bounced off the demand, we got the elevation in the volume, we had the long lower wick, the candle itself looks very bullish, we would have gotten long at 63.44.75. Well, the candle that confirmed for this long entry was this one right here. So therefore, our stop loss is on the opposite side of this candle's wick. So you're going to be risking roughly 5 to 6 points. I don't put hard stops right on the opposite side because sometimes price could wick it. I want to see price break below it with weakness. And if it does that, then I'll get out of the trade. Or today we had a gap fill on SPY. If we head on over to SPY and we go to the daily time frame, this is where price was going to fill the gap at 630.77. As we can see, once price finally traded up into 630.77, we got a pretty bearish reaction because as soon as we popped into it, they sold it off right away. You can see that the volume did pick up as price traded up into that key level. So because of that, at the close of this 5-minute candle, that was your confirmation to go short. So you would be getting short at around 630.47. And again, your stop loss is on the opposite side of the confirmation candle. So that would take it above 630.77. So you're risking probably about 4 or 5 points again, because you want to see it actually break above the level with strength before you stop out. You don't want to just stop out because it breaks above it. So realistically about 4 or 5 points. And you can see immediately after that confirmation candle, besides this little pop-up right here, price dropped all the way down to 629.93. So if you're talking about this in future terms, you're talking roughly about like 5 points, which is your one-to-one risk to reward, about your one-to-one risk to reward. But again, you know what your stop loss is when you get into the trade, because whatever candle confirms for you to get in, I'm gonna say it one more time, your stop is on the opposite side. And you always want to be looking for at least a one-to-one risk to reward before you start trimming. So if you are risking 5 points on a trade, you want to at least be looking to make 5 points. If you're risking 7 points, you want to at least be willing to make 7 points before you start trimming. If you're taking profits at 2 points, but you're risking 7 points, then that's not going to make sense long term, and you're going to lose money long term. So again, when we trade into these key areas of supply and demand, we are looking for confirmation in the price action and the volume to tell us now is the time to get in. Now from there, some other reference points that I like to use when trading if there isn't any supply and demand, because we're not going to have supply and demand every single day, but some other reference points that I will use is going to be pre-market highs and pre-market lows. So pre-market high, what I would like to see is a break and retest of pre-market highs. And again, I'm looking for price action and volume to tell me actually to get into the trade. I'm not just going to get in just because price breaks above it. I want price to pull back, test it, and tell me, hey, you should get long. Now, in that scenario, your stop loss is literally right below pre-market highs because that's your point of invalidation. So price traded down into it, we got bullish confirmation added to get long, your stop is right below. You're risking pretty much nothing. And then if I was bearish, I would be using pre-market lows as a potential reject point. So I would like to see price break below pre-market lows and to come back up and retest it. This is a really good example. We break below, price comes back up later in the day, we reject it here, and we reject it here yet again. This is a very good confirmation to get short with your stop loss set right above the high of these wicks. And as you can see from there, price had a very quick and aggressive move lower. So if you were to enter short on this trade at the reject of this pre-market high, let's just say at the close of that red candle right there, you're risking roughly about like 6.5 points. But as you can see, price dropped 52 points. If you know where the market is likely going to turn and you wait for the confirmation, your risk to reward is always going to be significantly skewed in your favor. And that is how you are going to catch large moves in the market, again, because they are reversal points. So I do really hope this video helped you guys out and gave you guys kind of a reference of what to look for in the market. There's a lot of BS trading strategies out there using many complex indicators, but I like to keep my strategy very simple: supply and demand on the higher time frames, pre-market highs, pre-market lows, as well as opening range breakouts, which I have tons of videos about. But yeah, my strategy is very simple. It works for me and it works for my students. If you guys haven't seen the live trading that I do, like literally tap into it. I do it for free here on YouTube periodically throughout the week, but I am live every single day inside of my Discord, sharing my screen and calling out my exact trades. So if you do want to tap into the Discord, I will be leaving that link down in the description. Other than that, follow me on Instagram, Brandon Trades. And if you use Tradeify or Apex and you would like to support the channel, make sure to use discount code Brandon in all caps. Other than that, everybody have an amazing rest of your day, and I'll see you guys in the next video.